Welcome to the Broken Pie Chart Podcast, episode 254. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, all right, we had employment. And how are you? You can tell me that in a second, but let me set this up for you. We had employment, and it was bad news because it got revised down, but then the most recent one really beat the expectations. So that's kind of good news. And the market liked that. And then ISM came out, and we'll talk about ISM, but then the market really liked that. I don't know. It didn't like the employment, but then it really liked the ISM. I don't know, Jay. Is good news bad news still, or bad news is good news? I don't even know.
Look, I mean, so I'm doing fine, Derek. Thanks for asking.
Yes, of course.
The market's got a little sad face the first week of the year here. It's something we talked about that was a possibility that the market might go down. But the one thing that I noticed, Derek, so throughout the up and then the retracement and then the bounce, the market's still a little skittish right now. Considering the low volatility that it had. By skittish, I mean it can't seem to make up its direction throughout the day, right? This kind of, intraday reversals are happening multiple times. Today, for example, there's a trend up, like you said, then once down, then reverse, then once another time down, then a reverse up. So this is really, I think the market's really trying to make up its mind. It feels, to quote somebody on our team, it feels a little heavy right now. But we're not really seeing that in the options market either. So, I think the market's just trying to figure out its way. I think you get this start of year churn going on here. I know we'll talk about January a little later, but, hard to interpret what's going on, except for the fact that everybody was waiting to sell till the calendar year changed over. And that's probably a little bit of what's happening right now.
Right, because if you have gains, you're like, oh, I'll sell in January instead of December. And then instead of having to deal with those gains, if it's a taxable account in April or whenever they do their taxes, I guess you could file an extension. But, of course, we don't give tax advice. But now, if you sell it January 2nd, you don't have to deal with that until April of 25. So I think that's part of it. But Jay, also, we talked a couple episodes ago about the net long. What was that? The hedge fund managers or actively managed funds managers, they were net long like 103%. I guess some of this could be, where's the marginal buyer coming from? Meaning, who else? If all the active managers are long equities, you need more people, you need more buyers and sellers. I'm sorry, there I said it, Jay.
Oh, is that how the market goes up? More buyers than sellers? Yes, gotcha.
More buyers than sellers. Then it goes up if more sellers than buyers. Yeah, goods goes down. Yep, that's right. So I don't know. I mean, it's I don't disagree. I mean, I feel like, by the way, you look at the numbers for November, you look at the numbers for December, the markets have been on fire. I mean, markets don't go up every week. So it's okay. Take a deep breath. It's this is perfectly normal. And it wasn't crazy. It wasn't crazy at all. But I just thought, when you look at employment, we went a little quick there. The number today beat the estimate for new jobs or payrolls added, right? But they also said that the past 11 months were revised downward, meaning whatever was reported in those corresponding months later, they're like, oh yeah, we're going to revise it. And it wasn't as good as we thought. All of the job numbers, the new jobs created in each of those months, the numbers were revised down. So the market's kind of wait a second, we just blew out the jobs number. So that means the Fed's not going to lower rates, or they're going to raise rates. And then ISM comes out. So ISM, by the way, is, for anybody who doesn't follow it, today was the ISM non-manufacturing index. And I think, that's what it used to be called. It's now the services PMI, Purchasing Managers Index is what PMI stands for. And it basically looks at service companies in the U.S. And according to the ISM site, they survey more than 400 purchasing and supply managers in non-manufacturing services firms. I don't know the survey response rate. I don't know, because sometimes the survey responses can. But Jay, what happened was, and I know you read the whole report cover to cover, as I did, but basically they come out and they look at, okay, what's business activity, what's supplier deliveries, inventories, prices, backlog of orders. They have all these things that they ask on the survey, and this one item, the employment one, and the way this works is any of these are above 50, it's generally growing. Below 50, it's declining. Jay, unemployment today came out at 43.3%, or employment on the survey. So this is bearish. And it's the first time, the trend is now 1 month. And what that says is the direction is contracting from growing. So that comes out, and we saw bonds shoot up because interest rates went down. This happened within an hour. Like, the market couldn't decide what it wanted or what direction it wanted to go. So that's what PMI is. And I don't know, Jay, any thoughts on this?
Yeah. So, I mean, normally this is not a big mover. It's normally we don't really plan for it. I mean, it's a footnote in our investment committee meeting discussion, right? It's a moderate market mover. Today, though, it had a little bit of a different reaction. And I think the idea here is bad news is good news, right? That's the way you would interpret that, the way that the market reacted, where it's like, oh, the Fed may have to cut sooner because maybe the economy is not going to be as strong. We like the Fed cutting, so we're going to buy the market. It's kind of a weird dynamic there, which of course ended up reversing itself within another hour and a half. So, Derek, I would say it's a blip. I'm surprised that we even spent as much time, but I appreciate the education for everybody on it. It's not one I'm going to, we're not going to plan for the next month when this comes around.
All right, I'll delete the multi-page full report. I'm not going to send that to you. I just think it's kind of funny because throwing away the definitions and all that junk about these. It's like, okay, we want bad news because if there's bad news, the Fed will lower. It's like, okay, if we get enough bad news, we'll get a recession, then they'll have to lower. And it's like, but wait a second, in a recession, doesn't that affect stocks? I mean, it's just everyone go watch a game show. That's my new saying. It's, all this stuff is really noise. And by the way, I saw a chart. Who is this by? This is from Bloomberg and TS Lombard, and a little bit of a contrarian indicator. Jay, we've been really bullish lately. And I don't say like bullish, we're telling people to buy, but we've been highlighting some of the good things that have been going on the last couple. I feel like this is going to be a bearish show. We're going to highlight some bearish things.
Okay.
So this is
you got a lot of
contrarian.
bearish data?
I think I got some stuff. So contrarian data, Bloomberg articles mentioning soft landing, and they're showing us a chart here. And what is this? Percent of monthly total. So this is like, 60% of articles are mentioning a soft landing, according to this data on Bloomberg. And what's interesting about the past two times when it's approached 40% or even gotten above really 20%, there's been a recession, although one of the times it didn't. It was like, I guess before 2008, go figure on this one. It was close to 80% were mentioning soft landing. So I don't know, last year, 29 of the 30 economists said a recession. This year, it's different. Maybe this is saying, well, you're mentioning soft landing so much, it's contrarian and we'll probably have a recession. But what do I know?
I mean, you're going to eventually have one, Derek, right?
I can guarantee that, yes.
Yeah, at some point we will have a recession. And the question is it in 3 months or is it in, 18 months? Or is it in, 60 months? You could go a long time between recessions, right? Like between the the '08 and the pandemic, that's a pretty long time, right? And that one lasted, really, really for a short period of time. And some would say that, if it wasn't for the pandemic, the recession wouldn't have happened, all that kind of stuff. So, Derek, yes, eventually we'll have one. To me, I go again, like, what's the impact to my investing philosophy, right? Like, recession, is it a recession or not a recession? We're investing either way. Like, I know this is like broken record, but it's like a magnet that everybody comes back to the discussion about the recession. The market's going to be ahead of it most likely. The market will sniff it out first. And right now, the market isn't sniffing anything out when it comes to the price action on equities. So, I don't know. I mean, I know you've got very contradictory data points with what the bond market is predicting and the way the stock market is acting right now, but I'm not convinced because of the talking points. Now, look, you have always brought up the when the local news starts talking about how bad the Dow is, and they put it in the bottom corner of a cooking segment, right? You have a better analogy than I do.
It's the
on this one,
cupcake
but
index, yeah.
the cupcake index. Thank
Yeah.
you. And I would say I knew it was cooking somewhere. There's
Yeah.
food involved
No, you're
somewhere
right.
with your index.
No, you got it.
I don't know. Look, I don't want to be whistling past the graveyard. We're going to have a recession at some point. I don't know when it's going to come. So what do we do instead? I stay long and I hedge, right? I mean, that's kind of our general process. We're not trying to time the market. We invest in the markets that generally go up. Last time we talked a lot about the fact that the markets are up over 15% over half the time. So yeah, we stick with that and we hedge just in case when the recession comes, which eventually it will, it hits the markets early.
All right, I'm going to go more bad news or more interesting news that could be. Let's go all negative today. And by the way, as you said,
you could go negative. That's fine.
We're not going to do
negative.
we're not going to do anything based upon this. Like last week, we were pointing out markets go up most years. You said, but here's something we mentioned this, and I follow the the prices of container shipping. The price for a 40-foot container this week, according to who gave me this chart. It's probably on Bloomberg too. But Drewry's World Container Index increased by 61% to $2,670 per 40-foot container this week. And, this, we talked a little bit about it in prior weeks. I've also got data if you break, Shanghai to Rotterdam, Shanghai to Genoa. I think how you say that, right? Or Genoa?
Yeah.
Okay.
No, Genoa.
All right,
the salami.
good.
Oh.
Yeah. There you go. So those container ships, especially those two I just mentioned, I believe have to go through the Red Sea and the Suez Canal, which right now the ships, many of them are having to go the long way, about 40% longer down the southern tip of Africa. So, yeah, we'll see if this is like during the pandemic, it was pretty clear. You sent out boatloads of money. People bought stuff on Amazon. It had to be delivered and shipped from China. And of course, you're going to have a supply shock. You're going to have too much stuff, not enough boats, and all that stuff. But this is, if you want to, be a little down, you could say, well, wait a second. Doesn't this put inflationary pressure on certain areas? So it's just something to watch. I don't know when this all gets resolved. You can listen to other news sources for that, but that's significant. Now, these prices are nowhere near what they were during, the bad stuff. I'm not going to say the C word.
Yeah, but
you get labels.
Okay, you can use the P word. The P word is okay.
Pandemic,
but right? You told me that one's okay.
Pandemic.
Look,
yes.
Pandemic. That's. Thank you. The thing here, when I look at this data, is it continues to reinforce a message that the Fed has said. Right, the Fed has said we don't have any plans to lower rates in the near term. They've also said the biggest mistake that the Volcker period made was lowering rates too early and kind of letting inflation back in. This is just another point that says, hey, we don't know the things that are going to help kind of creep back in when it comes to inflation just yet. I don't think the Fed's going to raise anytime soon, but it goes to the discussion we had last week of when they cut, it's probably going to be a while. And I think this goes to support their reason for leaving rates right where they are for longer, which they've said. When you get a data point like this, I'm okay with that. And so, I don't know, Derek, I don't consider this necessarily a bearish point in and of itself. Could it be inflationary? Yes. Does it mean the Fed will keep rates where it is? Yeah. Which maybe then the market got ahead of itself too much and thought, oh, we're going to, they're going to lower rates in March. I don't think the Fed's going to lower rates in March. I would say there's very little chance of that. So things like this keep rates higher. And what did the market do today when rates were higher? They were up, they're down. Yeah, okay. I think it might slow down equity appreciation, but I'm not throwing in the bear market. I'm not throwing this in the bear ring just yet, right? This is a data point that keeps the Fed stable and where they are.
Yeah, I mean, I think that's right. And by the way, I happen to look AP Moller Maersk, which is a company in Denmark, biggest container shipping company. Yeah, I mean, so their stock, let's see, in November 7th, it was $6.99 US dollars, and today it is 10.33. So it's actually, I'm not going to say spiked, but it's like it's gone up recently because they have some pricing power now. I guess the only thing is though that they have pricing power, but one of the things you have to realize with shipping containers is if it takes longer to do the journey. Think about that. If it took you 10 days, I'm making this up. If it took you 10 days to go from one port to another, you got to unload, you got to load, and then in 10 days back. It's a 20-day round trip. But now if it takes you 40% longer, it's 14 days. Okay, you got to unload all that stuff, and then 14. Now it's 28 days. So that's part of it too. You're taking supply out of there. And that's all I'm going to say. I'm going to stop talking about shipping containers. If you want to read about the history of shipping containers, by the way, Jay, there is a great book by Mark Levinson called The Box. It's actually a fantastic book. But that's it, Jay. I'm done with shipping containers. Unless you want to talk more about it.
I think it's on the rise. I think, look, I mean, the driver of the dip in the market this week, I feel was, warships potentially having a conflict and impacting shipping. Okay, I think this will pass relatively soon. So good to watch, Derek. You see the impact here. I think this will probably resolve itself unless the conflict escalates, which I don't think anybody feels is really going to happen here. But it's not just us. It's not just the U.S. Right. So yeah, follow your news on international conflict if you want to know more about the shipping containers, and that has been I think the catalyst for the drop in the market.
By the way, before I move to our next point, I will point out the Fed has a global supply chain pressure index. And the way they measure it is standard deviations from average. It got almost to 4.5 standard deviations in January of 22. I don't have, the scaling on this isn't great, but I'll call it July of 23, June of 23. It was below the zero line by almost 2 or 1.5 standard deviations. It's kind of at the zero line right now, not including January data, but this is something that I watch and nobody else probably watches it but me, and that's okay. So let me move on then, Jay. I won't make you even comment on it. I'm going to just keep going on. The January barometer. So B of A Global Research and Bloomberg looks like they put out something. January is a reasonable barometer or predictor of the year. And the reason is if they look at S&P data going back to 1928, when January is up, the year is up 80% of the time with an average return of 13.2%. And let's see. Let me just look at the numbers here. When January is down, number of years it's positive is only 17. So 47 out of 59 when January is up, you have positive years. Only 17 out of 37 have positive years when January is down. And, the returns, so if January is down, the average annual return is negative 0.72%. I just said when it's up, it's 13.23, overall 7.85. So, all right, I mean, go January, right? And then there's also some data about, the first 5 days as a barometer. And if the first 5 days of January negative, average 1.1%, and first 5 days of January positive, plus an average 11.22%. Go January. Get your jersey on, Jay.
Yeah. All right. So look, we've done multiple studies in the past here of, what happens per month after the first month and those kinds of things. So I always like to look at, great, January happens. What happens after January? Don't include January in this data. And so one of the data points within this is what happens, the average February to December return. So this is interesting, right? So if January's up, the average return from February to December is 8.7%. But if January's down, the average return from February to December is still a positive 3%. The chance of an up of an up February to December is 60%, even if January is down. So, look, yes, go January, but okay, if January, it's nicer, your chance, it's better chances that you finish, the 11 following months after January. That's great, but generally still the market's up, Derek. I don't know, you're trying to bring me down. You try to throw a bearish at me. I go, history tells me it's still bullish after that. And even in this first 5 days, right? The first 5 days, if the first 5 days are negative, right? Forget about what the rest of January does. The chance of the market being up from February to December is still over 50%. It's 56%. So you still have a better than 50-50 shot of having positive returns for the rest of the year. So yes, go January, but just because January is bad, I can think of years that we've traded where January was bad and we finished out just fine the rest of the year. I think probably 2016 is one of those, Derek. Do you remember 2016, January? First 3 weeks of January, the worst 3 weeks of the start of any year.
Was it
2016 finished?
Was it -9 for January? I forget.
I believe, yeah, it was like a Dow number, right? Worst Dow. I mean, we don't follow the Dow, but the point is, finished out great that year, right? Finished strong, 2016. So, okay, it's good to track January. We watch it. Don't let it, depress you for the rest of the year.
I'm glad you picked up on that. And I think the other part is they use averages. And for anyone who's listening, here's a little public service announcement. When you use averages, let's say you have a room full of 10 people and one of the people is worth $1 million and everyone else is only worth $1. Well, the average wealth in that room is 100,000, but that's clearly not indicative of the situation. Median would throw out sort of the outliers. So I could see, we'd have to look, but to your point about 2016, if you have outlier years, those are going to be in the averages. And so, if you take out the outliers, what if January is just down 1%? What does that mean for the rest of the year? So, yeah, I don't know. Remember the Super Bowl one too, Jay? Wasn't that when the NFC won? I don't even know if that means anything anymore. NFC team wins.
No, well, there's something there, right? Yeah, whoever the NFC versus AFC winning the Super Bowl. We should look that predictor up. We're not Super Bowl yet, although probably the Giants aren't going to make the Super Bowl this year, Derek. You think that's probably accurate? That's a good prediction.
Well, they have been eliminated from the playoffs, I believe. So
see? I wasn't so wrong about that.
It's not like, the Pro Bowl where if 37 other players pass, they're like, hey, Jim McGinsky, you're in a quarterback for no, it doesn't happen.
The McGinsky effect. Yeah, kind of like Florida State playing Georgia, and none of the players showed up for Florida State.
Yeah,
in the Orange Bowl.
I'm surprised they didn't contact your son to maybe transfer and suit up. I mean, I know he didn't play football.
Go to the game, but he did go. He was fairly disappointed at the blowout.
That's rough. You go to the game. So I was going to say at the Orange Bowl. That's old school. It was at Dolphin Stadium. Is that right?
Yeah, the Hard Rock.
Okay.
But yes. Yep.
All right. So, all right, I want to talk about volatility, and I want to talk about but not yet. I want to get to, we got to talk about members of Congress and their trading. But remind me, Jay, we need to talk about premium and volatility selling and a lot of stuff like that. So if that's what you're looking for, that's coming. That's a little tease,
Yeah.
So I don't know if you knew this, but there are some pretty prodigious traders in Congress. And
really,
so Unusual Whales put out they basically, it looks like they took so members of Congress are required to disclose their positions or their trades. I don't know how long after They have to disclose them, whatever. So we know the S&P was up 24.8. I think that's the total return number they're using. It doesn't say that though. And Brian Higgins made 238.9%. He is a Democrat. I'd have to look up and see where it doesn't matter the party affiliation, but I'll just tell you. I wonder who's better, Democrats or Republicans. Mark Green, a Republican, plus 122. Garrett Graves, a Republican, 107. Nancy Pelosi, plus 65.5%. So I'm not going to read all these. I'll put a link to it in the show notes. But there's quite a lot of people who beat the market. I don't know, did Brian Higgins have a small position and, he bought options on tech stocks? I don't know, but I guess we could look, but I didn't look. I don't know, Jay, this is interesting. Or maybe not interesting.
I mean, no, well, here's the thing that's interesting in this list here. And again, I don't know, like you said, there's a lot of information here that we don't know. All we're seeing here is apparently the returns, the estimated returns for the stocks held in each member's portfolio against the market. And when you look at this list, it's like it's an uncommon distribution. How many on this list beat the S&P? Now, Derek, I don't know if there's another 500 below this that did not beat the S&P, right? It's a little, I can't tell if this is skewed, right? This can't be all of the members of Congress that had investments, right, in 2023, but there certainly are a lot that made 2 times the market, 3 times the market. So I bet you, again, I don't know everybody on this. So
I'll tell you, 535 is the total number of Congress, 435 in the House, 100 in the Senate. So you're right. We're not seeing everybody for breath.
We don't see everybody else here, right?
Yeah.
I'm just looking. It lists about 30 that beat the market, right? But some beat it by a lot, right? Brian Higgins making 240% compared to an S&P that made 25%. It seems like a lot. But you don't know, what they were concentrated in. Like you said, you don't know any more details. And maybe it wasn't even a large investment. But, it's I don't know if this is a chart crime or not. It's selective data reporting. But, Mitch McConnell didn't beat the market. That's 18 made 18% versus 24%. So I don't know. I know Nancy Pelosi was under some scrutiny for her investing in the past, right? So for her to make 65% against an S&P that made 25.
Well, she traded options too. So one of the things they do is this. I don't think it's an all-encompassing list, but they went and they showed some options. And let's see, Nancy Pelosi had $5 million disclosed value. Nvidia, call options on Nvidia. Hopefully that worked out. Must have. She was up for the year.
There's a good chance they did.
Yeah.
You bought them at the high right before earnings, and then you get smoked on time decay. But maybe I digress.
Tommy Tuberville, he's a Republican senator from Alabama, right? Yeah, because he was at Auburn. So he has some call and some put trading in here, and they list the stocks. He also trades commodities, he trades in the softs. So he's doing corn. I think he's done cattle. And then we have, Ro Khanna, Democrat from California. And we'll talk about him in a second. But he did 68 trades worth 2.9. He sold 66 trades of sold options worth 2.9 million and purchased 38 in trades of 2 million. But Jay, the interesting thing with him is they have this chart, trading activity of Congress. He made 4,253 trades, and last year he traded over 6,000 times. Rock on, Ro Khanna, trading options probably. I don't know.
Wow, his broker loves him, especially if he's doing option trades.
What's interesting, did they list how he did? Yeah, so he underperformed the market, though, with all that trading. He returned 12.7% versus the S&P 24.8%. Michael Call, a Republican, 1,800 times. Josh Gottheimer, 578 times. Tommy Tuberville, 389. So that's kind of, and then everybody else is sort of all clustered together. You can't really tell, but
Yeah.
yeah,
So, did you say he traded 4,000 times?
that's what this says.
Yeah, I mean that's what 15, 20 times a day. That's pretty active stuff.
I
I
mean, and
wonder
he's
how
trading
much
options.
legislation he's getting done. Yeah, there you go.
Well, at some point, I'm sure members of Congress will ban investing for conflict of interest, but they'll get around to it when they
Oh,
get around
right.
to it. Because they have
Yeah,
to
one
pass
of
the bill
these days.
themselves, So look here.
It'll be the people that are on the bottom of that list that would pass it, right? So.
Yeah. Now, in defense of some, and I can't see all the numbers. Again, I'll put it in the show notes. We're kind of done with this segment, but if somebody has, instead of buying index funds, let's say you had a manager who's doing individual stocks, and and if there's rebalancing and you have a couple hundred positions, if you rebalance a few times, I mean those trades could add up, even though they might not be materially that important. So anyway, just some interesting fodder there. But all right, so Jay, we've been talking about the VVIX for a while, and we've been talking about how that's really not moved. Today it moved, and so it's been in the upper 80s for a while. And of course, the VVIX measures the implied volatility of the options on the VIX futures. Remember, you can trade options on the VIX index, trade them on the VIX futures. And we'll give a public service announcement. There's a lot of things you would want to do before you trade VIX options. But Jay, it crept down to 82, 87 today. Any thoughts about like it almost seems like people are not. It's getting less expensive to purchase or bring in premium on VIX options.
Yeah. So look, here's why this matters to us, right? So this tells us that the expected move in volatility is coming down. So that means the volatility of volatility, the forward-looking expectation is that things are going to be less volatile, which is kind of hard to believe with the VIX already at 13, which is fairly low in its range. We've talked a lot about the market maintaining, kind of entering a new lower volatility regime, right? We talk about there's these things go in like years cycles, and we think we're probably entering. I mean, that's not very committed by me, but everything indicates that once we got through the nonsense in October, the November, December, now into January, even though the market was down today, so was the VIX, right? So I actually finished slightly up today, but my point is this is like we still see a contracting volatility. We still see premiums coming in, which means expected moves, according to the options market, look a little muted. So specifically, so why does this matter? Like, what do I glean from this when it comes to my investing when I'm like VIX of 13 or a VVIX of 80? What's that really mean to me? And it means right now there's not a lot of speculation in the market either way, up or down. And it could be more of the same for a while. The VIX looks out, kind of does a weighted average over the next 30 days of S&P option premiums. And so, over the next 30 days, what's going to happen in the next 30 days, Derek, right? We're going to start to have some earnings, right? When did we say earnings season usually kicks off with the financials?
Friday, the banks. Is it next Friday? I could be wrong on that.
I think you're right. I think it's next Friday. And then we start to get some of the big tech names in late January, early February. But the market doesn't seem to have a lot. There's a Fed meeting, though, Derek.
There's one of those, huh? How about that?
Yeah, there's one of those things. So I think we could see a little. I think we'll start to see the VIX calculation, the VIX index, start to have to weight more and more the higher volatility that's implied in that last week of January, first week of February. But until then, it's the options market is telling us that things are going to be muted for a while. Again, small moves, 0.5% move a day. those kinds of things is what, maybe a 0.75% move, despite what happens intraday. Like today, the market moved almost 1% peak to trough, but that's not where it finished, right? It finished at 0.2% change. Those kinds of things can happen intraday. I think I said before, the market was a little skittish. It can't really determine which way it's going to go. There's probably a little more of that. So what the options market is, if that was your only thing with that lens, with just the option lens, it's telling us that things are going to have muted moves for a little while. And we shouldn't, nothing, of course, as I say this, I'm sure something will happen on Monday or Tuesday, but this is what the option market is kind of predicting. Slow moves again, no real decision. Can you kind of creep upwards? Absolutely. Just like we did in December. That seems to be where the bias usually lies when the VIX is on the lower end of the scale, like it is today with a 13 handle.
I know we don't really talk about individual stocks that much, but one of the things I like to do is look at, let's look at Nvidia. So Nvidia is a chip stock. We know it's been in the news with AI. And
it's a magnificent seven. It's one of the mag sevens.
It is. Like I look at the straddle price, meaning what's the at the money call price and what's the at the money put price. And that's, to me, is always an interesting gauge of, like, if you buy that, how much it has to move. And then I look at some of the, like, your cost of hedging. And maybe February is not the right one to use. Maybe we can go out to June's about 168 days. June's probably a better one. But if I look and, 10% down from here is, what does that cost? The cost of hedging on a very, very volatile stock. If I can just
11.5%, right? 11 or 12%. If you want to get long puts, 10. I mean, you could either go 9.5 or 10.5. But it's like, let's just average it to a 12% cost if you want to buy puts at the 440, 445 level.
Yeah. And now maybe let's bring up the S&P, like SPY, and let's see the June expiration, and just kind of say, what if we just want to buy the SPY, around 10% down put, and it's 168 days, so it's less than half a year, but you got to annualize it, that type of deal.
2.3% annually to own a 10% out of the money put. So the 421s are almost exactly 10% out of the money right now.
Mm-hmm.
You want to own that, it's going to cost you 2.3% on an annualized basis. So just over, 1.1%, right? $5, $4.99. What a bargain. $4.99, you could buy the 421 puts and basically throw protection on it 10% down on the S&P between now and June. And that's fairly inexpensive, Derek.
It's
I'm
very
fairly
inexpensive.
in air quotes. Yeah.
The reason why I bring this up, and I think why I did, it's one, to show the sort of difference between a higher implied volatility stock like Nvidia and the S&P. And the S&P right now, and you mentioned hedging earlier. That's one of the core things we do is buy and hedge, and the cost of hedging is very cheap right now. And one of the interesting things about talking about how cheap protection is when you think about it, for an equity investor, if right now you said, well, annualized, it's, would you say 2.7 annualized cost of hedging?
2.3,
10% down. So you think about that, you say, well, I could buy protection. And if that's all you did, about 2.3 annualized cost of hedging, you buy those puts, and then you got a floor there from the point in time right now. Like, if you put money in the market right now, you could say, I'm going to design a hedge, and at worst case, as long as the hedge is on, I'll lose 10% plus my cost of hedging, so 12.3%, and I know I have a floor in there. That's like, and you and I always say, if you're worried about a 10% decline, then that's a different type of investor, and that's fine. But that's not necessarily an equity investor. So that's cheap, Jay. That really is.
It's low. Look, everybody, we talk about this all the time. Is the goal to beat the market when it comes to investing? No, that's not everybody's goal. Some people's goal is, hey, look, I know I need to make X percent over the next 10 years before I retire. I don't need to take excess risk to hit that number. A lot of people don't need to beat the market, right? So what are ways, though, to be invested in something that has a tendency to go up? We've talked about this multiple times, right? 70% of the time the S&P is up, half the time the S&P is up more than 50%. That's a pretty good investment thesis. Okay, if I was to follow that, but I don't love the volatility that comes along with an equity market, like when in 2022, when the market was down 20%, around there, 18, 20%. I don't want that. I can't afford that. I can't afford to lose 18%. So you use the equity markets like the S&P as kind of your base, because history tells you that tends to go up over time. Okay, great. So, but I don't want all of the risk that can come with that investment. So then you put a little money aside for protection. A lot of people don't know that they're hedgers in life, right? You have car insurance, you have health insurance, you have renters or home insurance. Americans are forced to buy insurance. We're not forced to buy it in our investments, of course, but why not apply the same concepts and use options to limit your risk? One of the things we always say, Derek, is the only thing you can really control is your risk. So if you don't need to, quote unquote, beat the market, if you want to beat the market, there's other strategies for that. Absolutely. We've got some of those. We won't even get into how some of those did last year. I'm laughing because it was not awful, pretty good. But what I would say is, for those folks that wanted to limit their risk, especially the way last year started, you could stay invested. You get to play invest in a space that tends to go up, but you could do it in a protected way. That's when options come in and reduce your risk, because you could define how much you could lose over any period of time. So, Derek, I think I know why you brought it all up, but I always go back to, it's not about beating the market all the time. If there are strategies that are designed to beat the market in up years, they probably will lose more than the market in down years, right? There are things like that are out there, and so for those of you that want that, that's great. You could do that, but the simple hedging makes it very easy to invest in the equity markets, get the benefit of history of generally the markets move up higher, but do it with reducing some of the risk associated with stocks.
The Nvidia one's a good example too, because of course Nvidia is going to be higher 10% down because the implied volatility is down. The probability of Nvidia going down 10% is much greater than the overall market going down 10%. Of course, it's a single stock, and just alone being a single stock, I'll put a link in the show notes to we run concentrated hedging for people who have concentrated stock, especially people who have a low cost basis, and we kind of show some of the ways that we hedge it. But of course, a single stock on its own is going to go down more. An implied volatility stock like Nvidia, it's been volatile, is going to cost more for the same amount of downside protection. The interesting thing with a stock like Nvidia, you could say, I mean, look, those stocks went down. Was it Meta and Facebook or Meta and Facebook are the same? You know what I'm talking about. Nvidia and I mean, some of those went down 50, 70% at one point in 2022. Of course, they've come back. But the other thing you can do is, I mean, you could define and say, okay, I'll take the first X percent down, but then I want to put a floor in, and I want to keep the floor, but then, don't have me lose from 10% to 40% down. Like on these high volatility stocks, there's still premium really far away, and you can actually spread that off. We're not giving recommendations or anything. And the last thing we do is give recommendations, when we deal with individual, with advisors helping their clients or with individual clients ourselves, like you go through a process and you find out what the risk tolerance is. So we're just sort of talking out loud, but there's a lot of things you can do to manage that cost of hedging, Jay.
Like one of my favorite things that you can do is when you're long stock is to use a collar, right? We've heard it's not options 101, but maybe it's options, it's maybe the second semester class when it comes to options, where you're selling calls to pay for your long put protection. And there's this wonderful thing known as skew, where you look at the difference between the calls and the put options. And actually, you could create this collar, right, which defines your downside risk, but also limits your upside risk. Where right now, Derek, I don't know if you saw this, and I don't know if you picked this on purpose when we called that Nvidia, but while you could buy that downside protection, we talked about being about 11%, 12%, you could sell options on the upside for that 11, 12% income, but you could do it much farther away. So you could build this collar that's got a downside limit of 10 to 11% down, but you will participate up to about 18% appreciation of the stock, up to 580. So if you owned Nvidia and you're like, look, I'm not sure which way it's going to go, I'd like to put a hedge on here and I want to pay for it, you could have a zero cost hedge where the calls fully pay for the put over that June timeframe, where your downside is about 10%, but your upside is about 18%. That seems like a pretty good ratio of, gains versus losses opportunity. And the odds, by the way, are the same on both of those, right? The probabilities. The probability that the Nvidia goes down 10% is about 30%. The probability that it goes up 18% is actually 33%. So you even have a greater chance of it going up 18 versus going down 10. So you could kind of define that range. And so it goes back. Look, I don't know what the market's going to make next year, but having a 10 to 18% opportunity, that seems like a decent little slice of what I would call, your idiosyncratic risk. Put some money aside in a single ticker. Not recommending Nvidia, like you said. I know everybody thinks AI is the hot thing. By the way, that's why the calls have so much more juice in them, is because there's more upside bias in the options market. So use that to your advantage, and you can have a position on that limits down to 10, but captures up to 18. It's not a bad deal. You could not do this 2 years ago, 5 years ago, 10 years ago. The options market, because of interest rates, wouldn't allow you to do this. Today, that exists.
You knew exactly why I picked Nvidia, and you went right for it. So there you go. You and I didn't even prep
Sorry.
this. No. That was my intention. I wanted you to go there. So that's the payoff. All right, Jay. Maybe we'll definitely talk more about volatility and everything next week. Any recommendations this week that I know you had some travel. You probably watched some stuff on the plane. I don't know. Anything the audience should be looking at?
Let's see. I continue to watch. I think I got 3 shows going right now. So watching Fargo, I mentioned that. Watching Reacher, we'll mention that. But the new one I started watching, I think, is Bodies on Netflix. I'm 3 episodes in. I'm not convinced yet. So it's okay. It's kind of a sci-fi thing that happens over 4 different time periods. Seems interesting. It hasn't, it fell off. It didn't fall off my radar, but it's like third. So I don't know. Maybe it's not a strong recommendation. But that's kind of what I'm watching right now.
I'm a little late on this one because it's Hard Knocks in season, so they're following the Miami Dolphins. Not that I have any affiliation or rooting interest in the Dolphins, but I just find it interesting because their coach is very analytical, and you wouldn't expect him to be sort of a head coach. But you sort of see behind the scenes. It's interesting. So I don't know. And then the other thing I mentioned, Mark Levinson's The Box, like shipping containers and the standardization of container sizes and all that stuff. It's actually it's so important and so impactful on how global trade is. So that's a good book. That's what I got, Jay. I know you're
All
not.
right. Well, look, you brought it up before. It's a good one.
Yeah, I know you're not a Dolphin fan. I know, while you could go to the games, I think you've gone to when the Giants are there, but they are in your backyard. So
listen, everybody's rooting for the home team right now. So yeah, we'll see how they do. Although I think they got smoked by the Ravens, didn't they? I think a little disappointing there.
Kind of did, like 56. I don't know. I think the Ravens just scored another touchdown. I think they just keep scoring.
They're still scoring on the Dolphins. Well, although I was happy the Dolphins beat Dallas. So what does that count for something?
Well, look, I was torn because the Arizona Cardinals beat the Philadelphia Eagles, and I love seeing the Eagles lose, love seeing the Cowboys lose. But come on, Cardinals, just lose. You went from having the 2 pick to now I think they're 4. That kind of matters. Like, what are you doing? Like, do less, guys. So there you go.
I think. Do you think there's a little bit there where Kyler Murray doesn't he doesn't want them to pick a quarterback replacement, so he's changing their draft pick? I mean, is that something you guys are talking about in town?
Well, it's called just sit them. Like Just put me in a quarterback.
Do a Russell Wilson. Gotcha.
Yeah, it's not hard. I mean, Jim McGinsky at quarterback is anyway. All right, Jay, that's it. Let's wrap it up. Go.
Have a good one, Derek.
Happy trading to members of Congress. Good job, guys. See ya.